Hello and welcome to the ByteTree Quality Quarterly Review. This is the first one that we've done to cover the quality portfolio. That's been a year in the making. Most of the hard work was done by Kit. The stocks were chosen by the both of us, but he did all the hard work. He wrote 7,000 words across 25 stocks, and then there was a lot of research that never got published as well because they were rejected. So there's a huge amount of effort that's gone behind this. Kit, do you mind flicking the slide to the disclaimer, which I probably ought to mention? This is not investment advice and that sort of thing. Next slide, please. So at ByteTree, a quick overview. We've kind of got three core portfolio services: the multi-asset investor that's been around for over 10 years now, which I write. And then we've got the two newer services. Quality was launched 3 years ago. I beg your pardon. Venture was launched 3 years ago, which is a sort of fast-moving, high-return portfolio. And Quality was launched 1 year ago. And that's a slow, robust, defensive portfolio. So kind of between all the portfolios we've got here, there should be more or less something for everyone. And I would just say, it's been, bringing Quality in really was there to balance the whole thing, because also we know quite a lot about gold and Bitcoin and those sorts of things. The multi-asset was always really built for a UK audience, so it's not particularly global like the other portfolios. But nevertheless, it serves a very strong purpose for a lot of people. But Venture being the high-risk portfolio and Quality being the much lower-risk portfolio fit together very nicely. I think the point is that all the stocks that we pick at ByteTree kind of fit the same mold. We look for cheap stocks that are on the turn, value and momentum, if you like. And so that's really our thing. The difference with Quality is we're looking for the world's best companies, and these don't turn around very often. So we're looking for things that have, they're cheap, they're on the turn, that we can hold for a good period of time. So Kit's going to tell us all about it, but a couple more slides from me. The first is, the background of Quality. The blue line is not our portfolio; it's only been a year old, but it's a sort of proxy of what happens if you're a studious investor and you're risk averse. Low volatility stocks are shown there, and then high volatility stocks are shown in red. And this is the sort of fast stuff that captures the headlines and drives the bull and bear markets. All the things that are going well and all the things that are going badly are reflected in the red line. We're rejecting that red line with the ByteTree Quality Service, and we're going for the blue line. So it depends who you are. Some people like the red line, and some people like the blue line. Buffett put it so well recently in his last letter, one of his last letters, saying that the stock market is a church with a casino attached. And whilst parts of ByteTree don't mind putting a toe into the casino occasionally, we spend most of our time in the church, and I think the Quality portfolio is fully inside the church. And then just to show that same slide again, but really to focus on 1999, the last time there was a tech frenzy, and then followed by a credit crisis in 2008, just to show you the difference of what can happen. Even though those two lines have both done well over the long term, there's a long period, 1999 to 2012, where $100 invested in high beta stocks, high volatility stocks, call them what you will, basically lost 50%, including dividends. And the cautious investor ended up doing very well, trapping his money. So this is why we've launched Quality. We think it's a very timely moment to do this in the sort of history of markets. Most of these stocks, this sector has really been very weak since 2021, and we jumped at the chance a year ago. As I said, all the hard work was done by Kit. Congratulations, Kit. It's been a hell of a run. Are you pleased that we finally got a full portfolio?
Yeah, hugely pleased, and thank you very much. That's kind of you to say. Sounds like it's time for me to take over. And I'm just going to start by sort of talking about what we would say a quality company is. And the starting point is very simple, which is these are large and liquid companies. There are no small caps here. They will be diversified by country, by client, by product. And they're low volatility as well, which means the market has had decades to learn to trust them. So you're not going to hopefully see too many surprising jumps, things crashing by 50% in a day, or like Moderna yesterday going up 200% in a day either. This is a calm ride. Resilience is a key part of that. And that means, like I said, global diversification is one thing, long histories in the stock market for investors to learn what they do. And it's resilience not only of the share price, so we've looked at how they've done in previous bear markets, but also of sales. So these are companies that are selling things people need rather than what they want. So in an economic downturn, people will continue to buy food and medicine and insurance, even if they give up on their car or their weekly trip to the restaurant or their yearly trip abroad. Predictable growth is the next element. We want these companies to be growing long term, and we've hopefully seen that happen for many decades in the past and have reasons to believe that will continue into the future, avenues for them to grow into. And that growth should also be profitable. So some companies, newer ones especially, might be growing very quickly, but without making a profit. We want these companies to have high profitability that is sustainable. So not only are they able to charge premium pricing because of better products, better brands, better marketing, but also they're able to sustain those high margins because whether it's through different competitive advantages or a moat, as Buffett would call it, their competitors struggle to catch up, however much they invest, however hard they try. Another factor we'd look at is sort of strong cultures and strong management, and that's because cultures, they really endure through generations, through product cycles, through technology revolutions. A culture that leads to success will endure those things and keep going for very long periods of time. And strong management teams, likewise, they're just long-term in the way that they think. They're focused on cash flows. They're focused on the customer and pleasing them rather than on pleasing Wall Street at the next quarterly earnings report. The last couple, they tie in, but pricing power is just the ability to be inflation resistant. So when that inflation came through, could you pass on some of the costs to consumers? Will consumers switch away very easily, or are they very loyal? And finally, those irreplicable assets. There are just a few cases in the global economy where you don't need two airports, you don't need two railroads next to each other, or two communications, telecoms networks. And so once one of those is built and owned, you have a sort of quasi-monopoly, and that generates the pricing power and the predictable growth and the high margins that we talked about. So that's a sort of unique case that we look at as well. And we just think if we follow those 7 criteria, that will lead us essentially to a group of 200 or 300 of the best companies in the world. And then we apply the ByteTree fundamental analysis that, as Charlie said, applies across everything that we do. Those criteria lead us towards a few sectors and away from a few others. I'll start with the ones we go away from. Materials, be that gold and silver or different industrial metals or agricultural commodities, banking and energy, they all share one single thing, which is that their key driver of their returns on the stock market is sort of out of their control. A single mining company, unless it's maybe Saudi Aramco, can't affect the price of the product it's selling. And so it's out of their control. They don't have the capacity to develop brand power, pricing power, anything like that. And so while they might be fantastic companies in their time, they're not stable long-term growers like the quality companies we're looking for. And cyclicals applies to anything else in that bracket as well. Meanwhile, on the other side, things like healthcare, insurance, consumer products, and software, they all have those criteria we looked at. Healthcare, insurance, staples, all things you're going to need through thick and thin. And software often is on sort of long-term multi-year contracts, lots of pricing power in there as well. This is how the portfolio has ended up. As Charlie said, took a year of building, 175,000 words of writing. At least that was how much we published. There was obviously a lot more work that we did that never made it to the portfolio. But here you can see going round insurance, retail, software, health is covered through health technology or biotechnology, as well as big pharmaceutical companies as well. Pet care is in there as a consumer product, so we're serving animals as well as humans. And if you go around, you can see the criteria that we're looking at sort of shines through in a few specific places. Charlie talked about how low volatility stocks compare to the high beta stocks, a smooth ride against a jumpy ride. But it's worth saying that we're also quite different from the low volatility index. Namely, we invest in many fewer companies. We have 25 in the portfolio. And that allows us to really focus in on ones that are higher quality and buy them at lower valuations. The low volatility index has 350 stocks. So regardless of their valuation, it'll keep owning them. And it's a very, very diversified thing as well. So we like to be more concentrated in better companies at lower prices. That's the goal. Going to talk a little bit about the environment as well. So what's sort of impacting quality stocks in the markets in general? A big factor at the moment is interest rates. So in the 2010s, we had very low interest rates, and that was a nice thing for quality companies who raise their dividend every year by a little bit and have steady growth and high margins and are very predictable. So they're almost like a bond with some inflation protection baked in. So when you could only get 1% on a government bond, maybe a 3% or 4% dividend yield on a big consumer staple stock was worth having instead. But then when interest rates rose after the pandemic, that sort of relative attraction faded, and also all of those companies had been bid up to very high valuations. So what we're seeing now is the reverse, where you've got low valuations of those great companies, and we don't know which way interest rates are going to go, but we do know that it's a better time to start buying things after they've had a horrible 5 years than a fantastic 5 years. So that was sort of the thinking that went into the launch of the service a year ago. What's driving these high rates? I mean, we all know that the Iran war has been driving oil prices higher. That pushes inflation higher, interest rates higher, and also lowers consumer confidence, because if you think the things you're going to buy are going up in price, you're not so confident about the future. That bond proxy thing comes into this as well, where the higher rates are not really favored by quality stocks. But what we would say is the resilient element of the companies that we bought, their defensive credentials, mean that in a true oil shock, if we saw oil prices go to $200 and the crisis in Hormuz worsening, by owning the best companies and by buying them at good times, at good low valuations, you would be protected from the sort of worst fallouts of an oil shock or a major recession that followed. Another big theme for the year is artificial intelligence. A lot of focus has gone on the builders of what will obviously be a massive thing in the global economy. And the builders is who's building the data centers, who's building the language models, who's supplying the power, who's supplying the semiconductors. And there's been a sort of arguably a bubble forming in those areas of incredible hype and speculation and high valuations. We've taken a different approach and looked further down the line and thought it will be massive, but only if it's widely adopted. So who's adopting it and how are they benefiting by using it? And so across the sort of sectors and industries we mentioned earlier, consumer staples are a big user of AI to help their marketing operations. So that's how quickly they can adapt to trends, how much content they can produce in a short space of time, how many places they can distribute it to across the internet. And the bottom left photo there is a picture of some Kit Kats falling off the back of a lorry. And that was an example where Nestlé, I think one of their trucks of Kit Kat deliveries was stolen, and they very quickly built a huge global campaign around the Kit Kat heist, sharing the barcodes and the product details, encouraging consumers to go to their shops and see if they could find one of the stolen Kit Kats. And it really took off and went viral, and was a great example of how using AI to turn these things around at speed and at scale is helping them market more effectively. Pharmaceuticals is the next one, and we and many other people see that as a key area where AI is going to have a huge impact in a beneficial sense. It's the human body, chemistry, biology, those are hugely complex things, and AI can accelerate the learning, the testing, the modeling, and the developing of drugs in that area. So they're all very excited, the companies there. Testing and certification, these are the companies, they check that there are no nuts in your dairy milk, and that there are no harmful chemicals in your iPhone, but they can also test whether the new AI models that are being developed and sold to your business have been built on solid foundations. They're not going to break out and hack into your services or destroy or share your clients' information. And so the digital service arms of these testing companies, they're seeing a good demand growth from AI. As for software companies, this is maybe the most sort of contested area. At the start of this year, software companies saw a big sell-off because of, I guess, the fear of disruption from AI. But what we're seeing on the ground is really that it's enabling these leading software companies, the best ones, to enhance their services, to include more features, and to therefore charge higher prices to their customers on the basis of a better offering. So what we're seeing on the ground is more a focus on what AI is actually doing than fears of what it could one day do. And the final thing we'd mention is that for insurance firms who are trying to model the weather or human behavioral patterns around driving or health, they are using AI just to manage the incredibly large data sets that they're working with and to help them model future risks with more precision. So across all the sectors we're looking at, we see a huge amount of benefit from AI to match the excitement around the builders of AI. And we mentioned that we thought there was a bit of a bubble forming in that area. Technology has had an interesting few months where it started the year very strongly, but it's had some pullbacks. And we picked out the 6 worst days for the technology ETF in America from the last 3 months. And you can see them there down the left, from 5% to 8.1%. And we looked at the return for consumer staple stocks on the same day. And you can see what an incredibly wide difference it is. So when technology was having a very bad day, when maybe the hype was escaping and capital was leaving the sector, we looked at where the capital was going, and it was flooding back into consumer staples. So it was rising strongly on the days when tech was weak. So there's an argument here that staples and some of these other unloved, beaten down sectors are a kind of anti-bubble. They're the shade while all the light has been elsewhere. And as the air gets sucked out of one, it goes back into the other. And that's a dynamic we're seeing as well. Now, the next thing I think we're going to do is look at a few of the companies. So we have made 3 of the 25 notes public on the website. So you can go to the ByteTree website and see the full 7,500 note on the history of these companies, the analysis of their business models, discussions around their competitive advantages, their peers, their financials, the risks obviously as well. And the first one is Diageo, the first stock that we added to the quality model portfolio. Why? Well, for starters, it had been going down for 4 years. It had reached a very high valuation in 2021, and it had been steadily grinding lower. And you start to get interested when you see that it's got the best portfolio, I think, of spirits brands across all companies around the world. And it adds Guinness, a beer brand, into that as well. It's serving people something that they've been doing for 5,000 years. Humans, wherever they have been, have found a way to make a spirit and drink it and bond with their village, their community, their tribe, their city, their country in that way. And Diageo, we mentioned the history of the companies that we like to see. It has some of the oldest brands in spirits. So the Haig family started brewing whiskey in, I think, 1627, and Johnnie Walker was founded in 1820. So it celebrated its 200th anniversary in 2020. And these are craftsman-focused industries of people working with their hands, with knowledge that was passed down from generation to generation from founding families 200 years ago. And they really cover, you see on the right there in that image, from the low value end to the very high value end. Johnnie Walker is the leading example, the sort of undisputed king of Scotch. But their brands include things like Smirnoff, Baileys, Tanqueray and gin. They're very strong in tequila. They have also 3 of the world's top 5 low and no alcohol spirit brands. And I'd give a special shout out as well to Lagavulin, a sort of small Scotch Islay whiskey distillery, the only one I've ever visited. So keen on that one too. And one of the notable things about Diageo is its inventory. So whiskey obviously takes maybe 10 or 20 years to age. And that makes it very different from something like a t-shirt. So when a t-shirt goes into the inventory, it degrades physically and it goes out of fashion. So it's losing value over time. Whereas whiskey in a barrel is getting more valuable with every passing year. And so that's a sort of key distinction to be aware of, partly because when Diageo put it into the barrel, they record it on their balance sheet. Let's say it's worth £1,000 when they put it in, and they don't revalue that higher over time. So while Diageo looks in some metrics like it has quite a lot of debt relative to the amount of equity it has, it's notable that if you were to revalue the inventory, it would be worth 2 or 3 times more by a sort of an even estimate. And that would make its debt load, which looks high in some cases, look a lot lower. But we'll talk more about that in a second. Finally, the background to Diageo's recent poor performance was declining drinking volumes across the world, and most notably in young people. But we started to sense a bit of a shift in that narrative. And an example of that came through recently when Stephen Bartlett, who hosts the Diary of a CEO podcast, he said on it that he'd had 2 glasses of wine and it had ruined 3 days of his life. Now, this sort of optimization, health-focused talk has become popular among younger people. But what was interesting this time is that there was a very big and broad backlash against it. And the idea was that optimization and health had maybe gone too far and people had been ignoring the social benefits of alcohol. And we don't want to, understate by any means the negative health impacts of drinking alcohol, especially lots of it. But there are social benefits too in the way it's brought people together, as we said, for 5,000 years. The opportunity came through that narrative shift, through the lower valuation that we saw, through the anti-bubble element where we felt it was so out of favor, but still had the incredibly strong brands and portfolio. And over the last year, what we've seen is a change in management. So this one CEO left about a year ago and a new one started around 6 months ago. And that strategic reset has come through pretty well now. And we're starting to see the stock respond to it. The outlook From him, the new CEO is Dave Lewis, who used to be at Tesco. They call him Drastic Dave because he's so focused on having a lean operation and efficient business. He realized or has diagnosed the problem not necessarily as just health-focused consumers drinking less, but also that Diageo maybe abused its pricing power. So they saw a huge surge in volume during the pandemic, during the lockdowns, when there wasn't a huge amount else to do and people had a bit more money in their pockets. And they raised their prices extensively through that period. But just when those prices reached their peak, the cost of living crisis hit as we all came out of our homes as well. So volumes pulled back. And he realized that Diageo needed to be more closely aligned with the customer, maybe on A, what they were drinking, and B, how Diageo were pricing it. So it's more customer focused now. The pricing is being rationalized with what consumers are able to pay. And internally, efficiency is a big drive. I think when he joined, administrative costs were 14% of its annual sales, and he's going to try and get that down to 10.5%. And his record at Tesco suggests that he will be capable. And I think the narrative shift around the company is very strong, and we feel that strategically the ship is definitely turning. The long-term history of Diageo, as you can see there, is for steady long-term growth in free cash flow per share. And that was also a key attraction and something that we see continuing because of the brands, the marketing, the reinvestment, and the products it has. The next company we're going to talk about is Nestlé. And again, it's a similar story, 150-year-old brands. You know, for Diageo, there are 500 million new people turning 18 or 21 where they live, so becoming drinking age adults. For Nestlé, every time a child is born, they have a new potential customer. Every new generation falls in love with its snack products. But it's also primarily a sort of infant nutrition brand. So the nutritional benefit element is maybe not what we usually associate with your Kit Kats, your Nesquik, your Milo hot chocolate, your Smarties, which are its snack brands. But it was founded by Henri Nestlé in, I think, 1867, and it was in response to infant malnutrition. He added flour and sugar to milk to strengthen what they were drinking. And that continues today. So infant formula is a huge part of the business, as is medical nutrition for people as they go through life. So Nestlé is really serving humans and also pets from the moment they're born all the way through until the end of their life. So they're doing that across the world, and that is a truly diversified business. Hundreds of products, hundreds of brands, serving all different people all around the world. So that's what we mean by large, global, diversified businesses. And like Diageo, it has 20 or 30 or more years of history proving its ability to grow free cash flow per share, which is the most important thing. The opportunity was similar. Pricing got carried away during the pandemic. The cost of living crisis hit, volumes pulled back in, and also it probably had overhired and overspent, and so it wasn't maximally efficient. They've had management turnover at Nestlé as well. They have a new CEO, Philip Navratil, and the chairman is also new because Nestlé's former chairman had some scandals surrounding romantic involvements within the company. The new CEO is Pablo Ayla. He comes from Inditex, which owns Zara, where he's very well renowned, again, for running an incredibly efficient operation. Zara is the sort of poster child for supply chain management. So we're hoping to see more of that coming into Nestlé as well. And again, the valuation was attractive. I think you can see there on the right, that's Nestlé's dividend growing steadily over the last 30 years along the bottom, those blue bars. And its dividend yield is currently the highest that it's been in that period as well. So just a sign that it's being cheaply valued relative to its past and relative to the 10% annual growth that it's been able to achieve with its dividend. Looking ahead, how will Nestlé grow with GLP-1s helping people to lose weight? Well, they're going to have to adapt, and they are adapting. So whether that's smaller portion sizes, higher protein content, vegan options, gut-friendly options, they're working on it all. And as you can see on the left there, it's got 150 years of research around infant nutrition. It's got the largest food and nutrition research network in the world, 160 patented formulas. With stability at the top, better management in charge, and efficiency improving, we think the outlook for Nestlé is strong. And again, a similar picture to Diageo, 2.5, 3 decades of steady free cash flow per share growth. Worth noting that this is in dollars because Nestlé is Swiss. The currency in 2024 wiped out a third of its profits alone. But if you look at it in dollar terms, you see a smooth picture there. Now, we're going to talk about one more company, a bit different. This is Amadeus, which is the opposite of Nestlé, where you see it in every shop. You might interact with it many times a day. Most people have half a dozen products in and around their house at any one time. Amadeus, you almost never see or interact with as a consumer. That's because they serve airlines and they serve travel agents. And if you're a travel agent and someone comes to you and they want a holiday, you don't want to have to search on 400 different airline websites. And if you're an airline, you want to be able to feed your data to thousands of travel agents online or in physical buildings without having to set up relationships with each one individually. And so what Amadeus was originally built as was a GDS, a global distribution system, where they collect all the data from the airlines and all the data from the travel agencies, and they allow both sides to go to a single place to find out everything they want to know. So a travel agent can go and see all flight data, and an airline can give its data to all the travel agents. So they're that middleman, and they take a tiny fractional fee every time someone books through that system. So €1 per transaction. And the fact that it's a really small fee means that for both the airline and for the travel agent, it's sort of a minor concern. They're not constantly looking to get away from Amadeus because it's just a tiny fraction of their costs. That's half of the Amadeus business. The other half is that they provide the IT and the software to airlines to manage booking, reservations, ticketing, boarding, all those kind of things that are completely critical to an airline's operations. And that IT services business has long-term contracts. The customers are all very sticky. No one will ever switch away from their IT software provider because the risk of disruption is too high, and Amadeus is one of the strongest competitors in the field. So their switching is very low. So it's a very stable business that's a sort of international toll booth on global travel. Again, the opportunity was a long history of steadily growing free cash flow per share and a share price or a valuation that just didn't reflect that. So the black line that you can see along the bottom is the ratio of free cash flow against the share price, and the higher it is, the cheaper it is. And what we saw in the last 6 months as AI threatened software companies and the companies sold off, we saw an opportunity because it was trading as cheaply as it did in 2020 when no planes were flying, no one was traveling. You couldn't have been more worried about the future of the travel industry in 2020, and you're getting the same opportunity today, but without that concern. So that was the opportunity with Amadeus. And as we show here, passenger numbers, which are the blue bars, global passengers boarded, the blue bars along the bottom, they took a huge hit in the pandemic, but they have now recovered and surpassed the level they had before. And, you know, Amadeus, of all software companies, has one of the lowest share price volatilities. And we talk about that reflecting market trust. It's because it's proven the ability to ride out these storms over and over again. And we think it will continue to do so. The outlook for Amadeus, the GDS business is going through a managed transition as the technology evolves, and they're managing that well. And AI is obviously the new thing on the block. So they're working on incorporating, agentic AI into their business models, working closely with their airline partners to make sure they're developing the right tools. And they're also expanding into new areas. So on the right, you can see a picture of biometric verification. That's from their latest presentation. They've been buying biometrics companies so that you might be able to just scan your way through the airport with your thumbprint alone or with your face. So when you go through an automated passport control desk now at triple the speed you used to with a human, that's enabled by biometrics, and that's where they're expanding to. The end result of everything we've talked about today is a portfolio of 25 companies that looks quite different to the index. If you go down the list, you can see that they're generally growing sales and free cash flow faster. They're larger, so the market capitalization of the companies on average is much bigger. And then they're cheaper, so the free cash flow yield is higher, which means cheaper, and the price to earnings ratio is lower than the index. So in all cases, we're buying hopefully companies that are growing faster at lower prices, and they're more profitable too. So the return on invested capital is higher at 15% versus 10% for the index. Now, there's a couple more slides before I hand it back over to Charlie. The first one is, what are the main risks to the portfolio as a whole? We've mentioned AI and how we're focused on the beneficiaries, but it is changing industries at an incredible rate, and that's something that we need to develop a sort of constant understanding of at all times. Another one would be GLP-1s, these weight loss drugs. These are affecting consumer demand for all different kinds of products. And again, the companies we're invested in, like Nestlé, are having to adapt their product offerings to that. And finally, we talked about the interest rate rising scenario. What's going to make us sell a company on the right? Pretty straightforward, really. If we're trying to buy great companies when they're undervalued and starting to go up, if they get overvalued, or if the thesis changes, or if a better company turns up at a lower price, we'd consider selling. And we're going to be constantly monitoring that as we go through. But as Charlie compared it to the multi-asset or the venture services earlier, we'd expect this to have a lower turnover over time than those things. We're looking to hold these companies for a long period. A final thing, Charlie, again, he opened with the discussion of the low volatility stocks against the high beta. And we just ran some analyses. Not all of the companies we hold in the portfolio were listed during the dot-com crash of 2000 and the global financial crisis of 2008. But the ones that were, we can look back and see how did they perform during those bear market crises. Dot-com was a tech and a valuation crash, and the global financial crisis was a credit crisis, if you will. And in all cases, along the bottom line, you can see the relative performance of the quality stocks against the index. So that's the S&P 500 is the index there. And generally, in each of the years and across the periods as a whole, these quality holdings outperformed the index through their sales fell by less, their valuations were more reasonable, the lower volatility reflected market trust. And in almost a Pavlovian way, like how people flee into the dollar or the yen or the Swiss franc in times of crisis as a safe haven or into gold, there are certain kinds of companies like healthcare, insurance, consumer staples that benefit from a flight to quality when trouble hits the market. So we've looked back. We don't think this is a scientific exercise. It's not going to predict how anything's going to perform, but it maybe illustrates what can happen if you buy great companies at low prices. And with that, I think I'm going to hand back over to Charlie.
Yeah, thank you very much. Very comprehensive and well done. So you look a little bit on the quality portfolio overall. I think the way to think about it is that whatever happens, these are great companies. And so the cash flow is always growing, or the book value is always growing right across the space. So one or two stocks might go wrong, but by and large, you've got a portfolio that's going to get bigger and bigger and bigger each year. Now, the prices can still go down, of course. We think they'll go down less than the market in a crisis, but still, when that recovery comes, that growth will come back to you, and the prices will recover quite quickly. Indeed, in 1972 to 4, there was the quality stocks, did take a knock along with everything else, but they were the first out of the box in the correction in 1975. So I think there's, knowing you own a great asset is a key part of this. So long-term growth in capital and in income, and it's got lower turnover. There's less to do. There's less to think about, and suitable for what we describe. It's not our term. It's an old term. The armchair investor, where you put your slippers on, grab your pipe, and just think about that capital and income growth over the long term. Lovely. So what we're going to do, so in the last year we've been building this, the focus has been getting on the 25 notes out. The focus has not been on servicing the portfolio so much, but that's where we go from here. So you're going to get a quarterly review like this every 3 months, and these are going to interlock. So the multi-asset investor will take January and April and July and October. I'm going to make a mistake now. The next month will be given to the quality portfolio, February and May and whatever it is, and then the venture portfolio will get next month. So we'll start doing venture as well. So every month there'll be a quarterly review. Don't worry about the calendar quarter. We're just going to focus on the last 3 months for that service. And so there'll be something to look forward to every month. So I think that's probably quite a good way to do this without trying to bunch everything up into one go. On top of that, there's going to be the 2 notes. One's going to be a very quick data update. So Kit's going to give you an updated portfolio with the prices and things, an outlook on dividends and asset allocation and sectors and that sort of thing. So just useful information. And then there'll be a proper update, which will tell you about what the companies have said and done as appropriate. So it's going to be a nice little package. You'll hear from us twice a month. One of them is just a quick look, see if that's useful to you, and the other one's a bit of a more detailed update on the companies. So very much for the armchair investor. And the final thing I'd say is, in the same way that in the multi-asset investor, it was really designed with soda and whiskey to be an all-encompassing solution. So you have the low to medium risk portfolio in soda, and the whiskey being the more growthy element of it, and you mix the taste according to how much risk you want to take. And so, the whiskey and soda, because I keep being asked this all the time about how we should put all these things together. And I kind of think of the soda and whiskey portfolios as a package, and in the same way, kind of quality and venture a package in that same way. So you would think about this as the soda element of the global portfolio, and venture as the more growthy part of a global portfolio. And of course, here, this is quite defensive, whereas in venture, we're not making any effort to be defensive. We're just trying to make money. So there's a very different mindset, although the kind of stocks that we pick are always the same. They're always cheap. They're always bottoming out. They're always starting new trends. And here you get the greatest companies, and in quality, you just get good companies. In venture, you just get good companies. Thank you for your reviews. More, please. We always like more of those on the Trustpilot. Next slide, Kit. So that brings us to the Q&A, and so please send them in. And I think I better come up with a question, because no one's got one in yet, so we'll give you a moment. I say, Kit, tell us, how was the marathon ride of writing 25 notes?
Marathon ride was probably the most enjoyable year of work I've ever done. I think what it taught me most of all that I really have enjoyed is given me the perfect understanding of how the world works through the lens of 25 companies or 40 or 50 companies that we looked at in detail, which is, Amadeus is a great example of something you never interact with, but that you use every time you travel, and how those systems work, how the world economy delivers a flight, a ticket, an extra bag to you when you go on your summer holiday to the south of France. And equally, you'd say the same for Nestlé or Diageo, is understanding what makes these brands so powerful, what enables Diageo to charge more for a bottle of Johnny Walker than anything, why their marketing is so impressive, and also how that flywheel works of the bigger they get, the more they can invest back into the products, back into the marketing, and the bigger that makes them again. So I think there are so many different parts of the portfolio, and they each had a huge amount to teach about, the underpinnings of the global economy, and I found that a fascinating ride.
Yeah, and it's been a very incredible year because, quality stocks, Terry Smith started doing this in 2010, and, we won't talk about his recent performance, but he had the same thesis. It was, great companies, low price, and those companies were very much out of favor in 2010. They were massively in favor by 2021, and once again they're back out of favor. So I think it is the timing's I think spot on for this. I mean, who knows when this tech turbocharged market's going to run out of juice, but all the expectations are it's coming soon. Right, we've got questions here coming in, so great. I'll push on with those. How would you advise me to add more quality by switching 10% across from soda? I've already have 10% quality and 20% whiskey. Of course, we cannot give personal financial advice. That is the one thing we're definitely not allowed to give. But I think that it's not particularly difficult to shift across some money from soda. But I think my point there is that you want to put soda into the same framework as the quality portfolio, and whiskey into the same framework as the quality portfolio. Now, soda and whiskey, as I said, they're very much designed for a UK audience. Hargreaves Lansdown, AJ Bell, the stuff on those platforms, which most platforms are getting better apart from Hargreaves Lansdown, of course. And so there is more flexibility to buy more things out there. So I guess we're moving with the times in that sense. But make no mistake, this is an equity portfolio quality, and the soda portfolio is a balanced portfolio. The soda portfolio is less risky than the quality portfolio, but the long-term return of quality should be much higher than the soda portfolio, I would expect. And so I hope that answers your question. But yes, you just want to think about soda being the least risky, then quality, then whiskey, then venture, and provided that framework makes sense to you, then allocate accordingly. Okay, Simon, do you expect some of the quality portfolio companies to be takeover targets in the future? Kit?
It's always possible, but again, these are generally on the very large side for companies. So for something to take one of them over, it would have to be truly enormous. The only specific example I can give is something like Diageo, which has had a difficult 4 years and has declined. The new CEO on the recent call, which was about 2 weeks ago, he very specifically and clearly said, "I'm not here to turn this around and dress it up for sale. This is an organic turnaround. We want Diageo to continue as a standalone business." And in general, Nestlé would be the same. These are old, proud businesses. And we're certainly not looking for things on the basis they might be a takeover target. The world of M&A is big and murky, and you never know for sure. But I'd say generally wouldn't expect too many of the companies to be taken out in that way.
Yeah, they are quite big in that regard, aren't they? But it's always possible. But mega mergers are quite rare. How many trades would you expect per year? What level is likely to be at? Yeah, it's a good question.
It is indeed, and it could differ as well. I think if you've done a good job of picking them up front, it can be really quite low for long periods of time. For example, if you made good choices in 2010, you could have perfectly well left them alone for 10, 12 years. But on the other side of that, we mentioned what would make us sell a company, and it is if they get too overvalued, if the thesis changes, or if something better comes along, we will make changes. And that will happen more often in times of extreme bubbles or extreme crashes. You would see greater turnover. If you had to put a number on it, it might be sort of 0 to 2 per quarter under normal circumstances. So what's that? 1 to 6 a year. But it could easily go much higher, or it could go lower if everything is going well. And it depends also at the sector level. Sometimes we're more allocated in one area and want to be more allocated in another. But that's something we'll learn as we go along.
Yeah, here at ByteTree, we're not incentivized to trade. We don't earn trading commission, and so we're only incentivized to do the right thing, and so we will do the right thing. And sometimes that will mean more turnover, and sometimes that will be less. It really depends on the market opportunity, which comes and goes. Is Kit going to keep looking for new ideas for the portfolio, or let the current companies roll for the next couple of years? I think it's just answered that. I mean, we're just going to do the right thing. Right now, Kit, we if we had to go get 30 ideas, the next 5 would be difficult right now, wouldn't it?
Yeah, they would, but I think this is a great benefit going forward, having the 25 already in, is that we can be even more selective going forwards, because you might be looking for, as we said, 2 to 5 a year instead of 25 in a year. And so the thresholds can be even higher on company quality, on valuation, on everything else that we look at. So hopefully we can see positive developments. But I think the answer is also we're saying that we're always looking. We have a universe of companies. We monitor these things on a daily basis, and we will see if things that we know are great are coming into our areas where we would be interested from a valuation perspective. And we mentioned that there were tons of companies that we looked at, some of them in great detail, that didn't make it into the portfolio. And so we have a good sense of a lot of the other things we might be interested in, and we're waiting for the market to tell us this is a great time.
How's the portfolio doing so far? Well, I can answer that. I can tell you exactly how it's doing. It started with $100,000 notional, pounds notional, and it's now 102.4. So it's 2.4%, which doesn't sound like very much since last September. But there's 2 things I'd say. The first is that it's been a pile of, most of it's been cash, and we haven't added any interest in that. We've ignored that. We're already starting forward measurement now, and this whole area is out of favour. What I would say is that the NAV has just swung around plus or minus 2%. So there's an incredibly stable portfolio. But I think that if you remember that slide that I was talking about earlier, that 1999 to 2012 experience, you do want to miss out on what might come from the indices, the market indices, and from the racy stocks. And this is a very neat alternative. So I think if you're asking the question, and has it made loads of money, and if that's what interests you, buy venture. That makes loads of money. This is stability first. If the stability appeals to you, that's quality in space. Percent turnover, I think we've just answered that. How sacred is 25 company portfolio? Just a consequence of 4% weightings? Yes. So I'll take that. I mean, the 4% weightings, I mean, you've got to sort of have an answer. We could put Berkshire Hathaway in at 6% because it's sort of conglomerate and it's so stable, and something else at 3%. And that's entirely possible we do that in the future. But I think that we wanted to be concentrated. In theory, a portfolio is diversified, pretty much after 15 stocks, certainly 20. And because they're good stocks, then 25 really gets you there. And the problem is that if you try and put too many stocks in, the quality of the opportunity is going down. So I don't want to be more diversified than we are, and I don't want to be much less diversified than we are. And if once one company goes wrong, 4% is not a big hit. So I think we're about right. Do you have a target geographic split? Kit, there's real life practicalities around this, aren't there?
There are. I think constraints are something we try and avoid. Flexibility is an advantage in investing, and there's also a big question of, are you focused on where a company is listed or where it's doing business? And almost everything in the portfolio is doing business all around the world, often on a pretty equal measure. Diageo and Nestlé are two great examples where they're on every single continent and not dominated by any single one. So you can invest in something that's listed in London, but you're essentially buying a growth story in emerging markets. And yeah, getting that balance right is one thing, but given that everything we own is pretty much global, focusing on where companies are listed is not a key priority. It's worth saying that we're probably less invested in America than a lot of other strategies at the moment, just because of how we see the world and how we see valuations and how we see risk. But that can change and go the other way if we see massive opportunity in a certain area. But yeah, that again, as Charlie said in previous questions, will always depend on market conditions.
So there are some other considerations. For example, Japan's quite hard to access for a lot of investors. So we would like to embrace Japan more. Actually, as it happens, there hasn't been anything we wanted to buy, so it hasn't changed anything. But we are aware of the fact that it's a hard market to invest in. Emerging markets would be off limits. They're too hard for our clients to buy the stocks. So think of it as Canada, America, and Europe in the main. But I think it's these platforms, the bane of my life. Crap platforms, particularly Hargreaves Lansdown, who just limit the job of what's possible in this business. But the better platforms, AJ Bell and some of the more international ones, really give us scope. But we're trying to make it easy for people to be able to replicate this portfolio. So that's a key consideration at the moment. Next question: how do you plan to reinvest dividends? Well, at the moment we're just collecting the dividends in cash and then incorporate them into the income account, and so the cash balance will grow. We're not doing scripts because the numbers aren't big enough. Script dividends, you need to have a much larger portfolio, and again it comes back to broking and what's possible in your environment. So we're just going to keep it simple, accept cash dividends, and put them back into the portfolio. I added 25% more when Coloplast, Salesforce, and Diageo dropped by 25%. What are your thoughts on this approach, adding more when the stocks drop? I love it. I mean, that's rebalancing, and we love rebalancing. It's very hard to do in the publishing world, isn't it, Kit? I mean, how would we put out notes every now and then saying add 0.1 here and take 0.3 off that? I think it would drive everyone nuts. So, I mean, in the soda portfolio, we've got that Guinness fund that does it. I mean, you like their approach, don't you?
Yeah, well, it's quite an interesting, the Guinness, the Global Equity Income Fund. They are an equal weight and regular rebalancing approach. And what that means is just that they try and capture the upside from some of the stocks that have done well in a few months. And recently that meant they got to sell some of their technology, hardware, AI businesses and funnel that back into consumer staple stocks. And that was well timed. And as you say, it just harvests good performance and reinvests it back into underperformance. So their strategy is good. As you say, for us, the dividends will go into the income account and we will periodically reinvest that when appropriate, but not in 0.1%, maybe in 1% when it comes up.
Right, Kit, what's the quality exposure to gold and Bitcoin?
I wonder if it's 0 or just above 0, but it's pretty close.
It's 0, but we've still got some questions, so we'll take them because we run out of questions on quality. Yeah, a very exciting couple of days for gold and Bitcoin. If you're a nutter like me who likes these alternative non-income, non-productive assets as alternatives in the portfolio, it's been a spectacular turnaround. And I think that the Besant statement that they're actually going to do QE, no one's calling it QE, but when the government accelerate their bond purchases at the long end of the curve, where an increase at the front end of the curve, which is exactly what America can't really afford to do because they've got very little issuance at the long end, unlike the UK, and too much up front. And so, it is basically a sort of money printing exercise. And so the alternative assets are loving it. And both of them have had corrections. So, Bitcoin is down half from last October to February. And I think that's probably turned the corner now. It looks very likely. 200-day moving average could be positively sloping by Monday. I mean, it's really remarkable how this is going to catch people by surprise. And then in gold, not quite as strong, but still pretty damn good. And the gold miners are really, really, out of the box on this one. So luckily, we put quite a few gold miners into venture. We put some silver into whiskey the other day, up gold in soda as well. So, I don't feel totally behind the curve on this move. I think we've done the right thing, but modest as always. And, we never go all in on anything. But haven't added any Bitcoin to whiskey, which I think is probably a bit disappointing. But it's a difficult one because who's the broker that won't take it? Oh, is that be Hargreaves Lansdown? Peter, do you have any other income sources than subscriptions? That's a business question. No. I mean, bold one day, hopefully will bring us an income and we have a data product launching soon. But no, we're a subscription research business. And then finally, is it crypto and blockchain innovators? Yeah, should we put crypto Bitcoin stocks? The thing about those things is they've all become AI stocks. They've sort of got involved in the data centers and that sort of thing. And so they haven't really behaved like the good old fashioned miners. They've repurposed. But yes, we will definitely be looking at things to do in that area. Great. I think we've got no more questions. If anyone wants to get in touch with me or Kit, then please do. Subscribers know our email addresses. We don't like to publish them because otherwise we get loaded with spam. But thank you very much for your time. Thank you for joining us, and well done, Kit, over the last year for the enormous amount of work you put into building this product. And it's been exhausting just watching you.
Thank you very much. Well, I think it's been a wonderful thing going through it all together and a fascinating process building the portfolio. I'd say thanks to everyone who's watched and listened. If you're watching on YouTube on the recording later on, make sure to subscribe to the channel because we're going to keep the video content coming more often. As Charlie said, a quarterly review every month for the different services and more other video stuff coming too. So do subscribe to that.